We have an unusual situation here in some senses of lots of relatively mature private companies lining up to go public pretty much all at once. Lyft is going to be the first one. What does it tell you about, I guess, the deal environment, the corporate finance backdrop, private investors, what they're up to right now?
Yeah, the one thing is the private market has gotten so big that these companies can stay private longer. And there's obviously advantages to that, where you can, keep your financial metrics private and your customers don't necessarily see what's going on behind the scenes. So it gives the companies the ability to extend out how long they can stay private, just because before they go public, because the private markets are so deep. But then eventually, these companies, whether they have too many shareholders or they just need more capital, have to go public, which I think you're going to see a flood of them coming out this year, obviously. So
that would seem to be the priorities or the demands of this company of this size having to find a public hands to put the stock in. Is that a cautionary sign? In other words, would you want to be a buyer of somebody who feels as if, look, it's just time, we had to do this?
Oh, no, I would. I mean, in honor of opening day, I think this is going to be a home run IPO.
Yeah.
I mean, when you think about the market opportunity, I mean, this reminds me of when I took Lyft public and Facebook, right? You're taking companies public that have massive engagement with consumers. They're transforming industries. When you think about, transportation being a $1.2 trillion opportunity, at $2 billion of revenues, that's nothing, right? And when you, like I was down at South by and waiting in line for the Lyft and Uber, pickups, you had hundreds of people. The taxi line was 20, right? So the dynamic has changed for how people are engaging with these services. And that, once you have that customer engagement, then you just add on incremental services and profitability. So whether it's Amazon, whether it's Apple, whether it's Facebook or whoever, it's about that user engagement at the end of the day.
Although the Facebook comparison is instructive, perhaps, because first of all, it had $1 billion in profits before it went public on an annual basis, and they had two customer sets, right? Advertisers and users. The users gave the information free. Advertisers were paying them for it.
Absolutely.
Whereas Lyft has to pay drivers, make a good deal for them, make it a good deal for users, and both sides seem subsidized.
So probably the better analogy there is Amazon, where you are providing a platform through which people can buy and sell things or engage on commerce. At the end of the day, I think that's probably the best one. And investors for a long time were willing to absorb losses because they saw the huge market opportunity and what ultimately it became. So I think that's the better analogy. And if you look through the P&L on it, whether it's R&D spend or marketing spend or whatever, you can see they went from 26% to 40% market share. That's pretty dramatic. And so do you need to continue to do that? I think they'll have more flexibility.
Investment bankers who work on IPOs talk a lot about their ability as humans to match companies' shares with long-term blue chip investors who aren't going to flip the stock on day one. How do you sort for that? Can you?
You can. I mean, by definition who are the long-term investors, so you try to place it with them. There's always going to be some people who, if there's a huge pop in the stock, they're going to get out of it. I think the benefit that they have is it's so oversubscribed that they can really cut people back to the level well below where they want to be, and so there'll be buyers in the aftermarket, and that's what you're going to see, I think, when it goes public.
You think there's a significant advantage for Lyft getting out first? Do you think investors are going to look at Lyft and Uber as essentially just the same way to play a huge potential market?
It's not like they don't know Uber's coming.
Yeah.
So at the end of the day, they've already factored that in. I think there's more than enough appetite for both companies. When you think about the amount of public equity that's come out of the market, that's pretty high relative to what's come back into it. So investors, I would argue, are starved for these kinds of names. And you think about the mega caps within the internet space, there are not a lot of them. So if you want to play this kind of a change in the economy, there's not a lot of places to go. So I think you have to play.
So if it's a good thing right now that there's a rush of deals because it does feed that appetite, what would be your sign that it's gone too far?
Look, I think at some point valuations, you have to take into consideration what's the realistic expectation over the next 3 years. And that's how I think about it, right? For someone like a Lyft that's doubling every year, I mean, you think about going from $1 billion to $2 billion in revenues, that's pretty dramatic. The likelihood is they will double that again and then double it again. Beyond that, then you could argue that'd be harder to do. So I would look at, over the next 2 years, what's the likely, trajectory that they will realistically achieve. And how do you get to that? You look at, the number of users, the change in the dynamic. I mean, the fact that they, identified 50% of their users are using it to get to work, that's a pretty fundamental change in terms of how people are engaging with these platforms. Because even in a downturn, people still have to get to work, right? And so that part, I would say, is kind of like the floor of a convertible bond, right? Those people are going to be there because they've changed how they're engaging with transportation.